Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Alex Coffey, Senior Market Strategist at Charles Schwab, and Sara Mehle, Senior Index Research Strategist with Nasdaq Investment Intelligence. We're here to discuss technical levels in the Nasdaq 100 as investors continue to broaden their exposure to other areas in the market. It is great to see the both of you, as always. Alex, let's kick it off with you. It certainly is a different story than when we spoke just a couple months ago in terms of how market composure is with breadth and that rotation that we're seeing out of some of the bigger names into broader sectors in the market.
Yeah, it really is. Jill, first off, thanks for having me as always. But yeah, you look at this market day after the CPI report, after a really, really strong start to July, a volatility free month of June. The day of CPI, we ramp up towards all-time highs and fade on the cool inflation print. And it really started this rotation slash period of risk off that really has been unprecedented for the year of 2024, where a lot of these market leading names, the NVIDIAs of the world, the Microsofts, the Metas, have really seen capital flow out of those names in real size. And then some of that's finding a new home in things like the Russell 2000, which has been perhaps a long overdue and extended trade. But given the timing being around that CPI release, being that that data was cooler than expected, what had been the playbook for taking more risk leads me to believe that we might be watching the market past its baton of concern from inflation to perhaps growth and the trajectory of the economy going forward.
Right. Sara, though, we haven't really had a major move in the Nasdaq 100 to the downside in quite some time, right? And you and I have discussed this over the past couple of weeks. From a technical perspective, would you say that this is a longer term trend or something that's a little bit too new in terms of the setup?
So a lot's happened on the point and figure chart over the last day. We saw the chart actually break that 19,500 level that we have been discussing, falling actually down to 18,800 today, because we do use intraday price action. But we are trading now on two consecutive sell signals. That violation yesterday of support broke a spread triple bottom, marking again the second consecutive sell signal. The good news is that from a long-term trend perspective, we are still trading well above the bullish support line or in an overall positive trend. That trend line has been in place since January of 2023, and we definitely have a little bit of support before getting to that level. Today's swing, as I mentioned, we added O's all the way down to that 18,800 level. We've definitely rebounded from there, but again, because we use intraday highs and lows, those O's are going to be there. So we might see more action develop on the chart tomorrow, but all this action, again, as you mentioned, is pretty near term and hasn't caused any significant long-term breakdowns on that chart.
Right. Alex, do you think that earnings expectations were perhaps a little bit too high? We know in the names where there was concentration risk, and I would argue for other parts of the market as well, if you did not beat handedly and raise guidance that meets the expectations of the street, you're going to get slammed with your stock. And that's what we're seeing, right? So when we had a Tesla and Google, it kind of like, there was that shockwave that went to the other names within those groups. Are expectations too high? Are people underestimating CapEx and spend that's expected to go into these AI priorities?
It may perhaps be a little bit too high. It's not even necessarily, though, to me, Jill, that the expectations are so high. If you look at something like Alphabet, they largely met. Yeah, they fell short on YouTube, but there's always going to be, periods where companies miss. If the expectations are set properly, we'd expect, some of the companies to miss. To me, it was more that the investor expectation was that these earnings events have been opportunities for these stocks to simply just go higher every single time. These trades have been historically crowded. So to me, Jill, it's much more of a positioning and sort of the risk reward pot odds conversation where there's maybe incremental upside if they do beat and raise because of how these stocks had been trading and how crowded that positioning was. And then in the cases where they do miss, which may be fewer and far between still, as we only have about 22% of the names so far in the S&P 500 that have actually missed earnings, the downside might be a little bit more of a trap door. And you've seen that in a name even as simply as Ford today. The stock down almost 20% on a day where the market's a little bit higher after we've been in a weaker market. So I look at it in that way, Jill, which is more of a situation where maybe good isn't going to be rewarded a lot, but the bad, you're really, really going to feel that pain if you're an investor.
See, and Alex, that's a concern to me, and I'm glad you brought that up. We almost get into these short-term mindsets where we're so used to seeing a specific sector or stocks within a sector that get titled to X, and you're used to seeing it go one way. I mean, you could look at history at any point in time, and it's just not the case that there are no ebbs and flows in the market. And I think investors have to be aware of that. And, human psychology teach you about FOMO, going through the pandemic and everyone was glued to their screens. There was nothing else to do. I feel like short-term memory sometimes gets disjointed from, the mechanics of the market.
Yeah, this is a really, really important discussion. And the one thing I would say is a caveat and kind of the counterpoint, you could have said this in January and you would have missed out on a pretty, really strong start to the year. So to me, it's less about all in, all out, short against the market in an extended period of time or following that trend, but more about, just proper risk management metrics and really having a plan going in, be that an exit to the upside when things go your way, be that an exit to avoid the downside when things aren't going your way. So we know that timing the market can be difficult. I'm more in the trading world, so there's a little bit more in that aspect of that. A lot of times the short-term thinking is more where my mind is. Right. But everyone's an investor long-term with their passive assets, their retirement accounts. And for me, this is more of a discussion where it comes to, if you have that feeling like I described, where, hey, this is a crowded trade, the easiest way to avoid that unwind is to start doing so yourself. Doesn't mean you have to get out of everything, but put on hedges if you want, or what I always say, the easiest hedge is simply to reduce the size of the position.
Yeah, and that's another important distinction. You have to think about your time frame more than anything else, because what I might think about a stock longer term could certainly be different in a day or swing trade where you want that volatility to exist, so that you have those multiple opportunities throughout the day, throughout the week. Sara, if you take a look at the other Nasdaq indexes, are there any other trends that you can discern in terms of where money is going? Anything on the technical charts that look either attractive or something you want to be more aware of?
Yeah, as we mentioned yesterday, the Nasdaq CTA Global Finance or Global Payments Index wallet is the symbol. We've seen some strength there. And particularly, I've been focusing really on the Nasdaq 100. And I mean, just those mega cap names, I just wanted to kind of bring that up. The Mag 7 we've talked about all year. They've actually, as a group, have dragged the index about 5% since all-time highs on July 10th. And they make up about 43% of the index. And other names in the top 10 that are dragging the index include Broadcom, AMD, and Applied Materials, all semiconductor names. So I just thought that was an interesting point to make. And we have seen some of these names rebound a little bit today, but I agree completely with Alex in the risk management and always having a plan. I feel like the only thing that's guaranteed is that the market will go up and go down. And having a plan definitely is the way to go.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.